Welcome to What is a Margin Account and How do they work? Well, simply, a margin account is a type of brokerage account that allows you to borrow money from your broker. Now, you can use your existing securities as collateral to access additional funds for trading. Now, you can start by depositing your own money into your margin account, and this is your initial investment. Now, with the margin account, your broker may lend you additional money based on the value of the securities you already own. This effectively increases your buying power. You can use this combined amount to make larger trades than you could with just your own money. For example, you could 3x your money. For every $100, you can now trade $300, and this is known as leverage. Now, keep in mind that the money you borrow isn't free. You'll typically pay interest on the borrowed funds. Also, if your trades decline in value, you could end up owing more money than you initially invested, and this is known as a margin call. Now, margin accounts can also allow you to sell investments that you don't own. This is called short selling. This can be a way to profit from falling prices, but it comes with its own set of risks. Now, it's essential to use margin accounts carefully and be aware of the costs and the obligations associated with borrowing money from your broker. Now, we want to encourage you to check in with your exchange for specific details concerning margin accounts.